Well, Donald Trump should be very, very happy because rate cuts are now fully priced in instead of for this summer or as early as September, in November. But those rate cuts, that rate cut meeting comes just a day after the election. So that means there is a chance we will get zero rate cuts until the election is over. A big win for Donald Trump, especially since, even as Nick T mentions in his Wall Street Journal piece this morning on CPI, Americans have had it with inflation. And unfortunately, the CPI report today, which was supposed to give us direction, was January, February just a bump on the road, or was it a trend of inflation resurging? Well, the numbers came in hot. As outlined over on ehack.com to make it easy for you. Remember, every time you go to Pooper, check on ehack.com. What do you got? CPI month over month, you've got a 0.4. Every item comes in 0.1 hot. You can see that on screen here. Core, month over month, year over year core. Everything comes in 0.1% over expectations. Markets looking at just 1.9 rate cuts this year, maybe 2.26 by January. The super core trend is not great. The super core trend is the biggest problem that we have right now. The last time we had a rise in super core was really when the Federal Reserve started freaking out. You'll see right here in about September, July, August, September, we bottomed out in super core in 2021. Unfortunately, we skyrocketed until the Fed lifted off on interest rate increases, in March of 2022. And we are now trending towards the longest uptrend in the super core. Now, super core is exactly what we pay attention to. Every single time we get a CPI report, the first thing we do is we jump in over here and we go, what's going on with services? Pet services up 1.9. We warned that we wanted to pay attention to insurances, pets, financial services, healthcare, all of them hot. Motor vehicle repair 3.1. This is month over month. So when you annualize a 3.1, you're talking 36% inflation. You just multiply it by 12. Don't use exponents when you annualize. 3.1% on motor vehicle repair, insurance 2.6, motor vehicle maintenance and repair 1.7. You've got health insurance up 1.2, hospital and related up 1.2, medical care services up 0.6, household operations up 0.8, pet services up 1.9, postage delivery 0.4, other personal services 0.8. Not great. All of these hot. That's super core rising. Since we did touch on medical, I want to give you a quick little heads up, by the way. Summer, baby summer. I'm already starting to talk to a discharge nurse, so we could be within 2 weeks. Knock on wood, or 3 surgeries are done, and she is recovering. So yes. But anyway, baby summer, hopefully we'll be home soon. So all 7 babies will be home. But anyway, going to the super core chart. This chart over here on the right is rough. This is a rough chart. The chart is going in the wrong direction. And so now you have to look at the implications. The implications are, A, clearly policy isn't restrictive enough. Clearly the Federal Reserve thinking that 5.5% rates is restrictive is not. It's not restrictive. How could it be deemed restrictive if supercore is skyrocketing the way we see supercore here? It's crazy. Then this also raises the estimates of the neutral rate, which reduces where we might end up going with interest rate cuts in the long term. The idea that we're going to go back to 0% rates is basically killed by reports like this, where inflation is continuing to resurge in the face of very high policy rates. And the economy is still chugging along. We don't have jobs weakness. If anything, we have job strength. Yes, some of that is affected by immigration, obviously, but the jobs market is broadly expanding. There is a renewed risk of a wage price spiral, especially since we think the ECI reports are going to come in hot, in part due to California still raising minimum wages during a time we're trying to get inflation to stabilize. Now, I'm not here to say people shouldn't earn more money. I do think people should earn more money. But I am also concerned that if from an economic data point of view, we start getting signs of a wage price spiral, the Federal Reserve will be forced to drive us into a recession. Again, this is actually what we're getting right now is good for Trump in the short term, because not getting cuts until November means the Federal Reserve is kind of going to look like they're behaving politically. The moment Trump potentially or the new president gets elected, that's when you're going to get rate cuts. Whoever obviously ends up winning, of course, delaying that until then is going to look very political. But, the data is also driving them in that direction. The problem, though, is if you stay at those higher levels for too long, you do increase the chance of a recession. A recession could end up on the next president's plate. So whoever it is, whether it's Biden or Trump or whatever, it is very possible that with rates having to stay this high and supercore moving up like this and a potential lead into a wage price spiral, the Federal Reserve is going to have no choice but to drive a recession to actually finish the job on inflation, and the Federal Reserve will do that if necessary. Obviously, this is not good for your interest rate sensitive stocks. Yesterday, we anticipated that the most volatile mover would be Sunrun, followed, of course, by the other interest rate sensitives. We thought there was maybe some hope for artificial intelligence, but at least this morning, there's really hope for basically nothing. The only thing there's hope for is the volatility index, Alibaba, and United Airlines. Other than that, you've got Sunrun down 7%, Open Doors down about 7%, Wayfair's down 5%, Enphase down 5%. You've got the TQQ down 3.9. That's because obviously your index is down about 1.3% right now. Arcade down 3%. Cheesecake Factory down 3%. You've got Tesla over here is actually only down about 1.8 ish. Nvidia is down about 2%. Nvidia now in correction territory along with AMD, and you really want to watch on Nvidia that 850 line. We are below that 850 line right now, and that's a big deal for Nvidia. Getting below 850, it is a support level. Breaking could bring us back to 731 for some violence. ARM, for example, down 2.5% on the day, though that's also been sort of a volatile up and downer. We'll see what happens, though, but with markets. But right now, you've got the bond market looking at a 4.48% 10-year yield. You also have inflation break-evens moving up. The 5-year inflation break-even is sitting at 2.55%. And the trend of the inflation break-even chart is not good. Keep in mind that Jerome Powell consistently says that inflation expectations remain well anchored. This is in the face of inflation expectations, just one measure of inflation expectations, moving up rapidly. You can see on screen here, we've been straight up since December. Jerome Powell has not changed his tune at all, and the question now is, what is he going to do, and what is the market going to react with when Jay Powell really ends up, going, oh no, oopsie doopsie whoopsies, we screwed up. When we get that commentary from Powell, how markets will reply will be very obvious, will be very interesting. Obviously, we're expecting to get Fed speak this week. We will get minutes today at 11 a.m., though I'm not sure how useful the minutes will be, given that we just got a third month of hot data out. So if you get minutes that say, hey, 2 months could just be a little bit of a bump on the road, unless we get some kind of hedging bets like, hey, if we get 3 in a row, that would be bad, then these minutes might not be very useful today. We're really going to be looking for is that Fed speak coming. Bowman today. We'll have other speakers going forward the rest of the week, like Walker will be speaking towards the end of the week. So we'll cover the Fed speak. Clearly, Raphael Bostic was not informed of having any kind of sort of pre-leak on what's going on, given that Raphael Bostic suggested, hey, it'd be great if we hit consensus. And you know what? Maybe, he sort of acted bullish, rather, and dovish, suggesting, hey, consensus or a little below would be wonderful news. And just accepting consensus at even where it is, somewhat implied, hey, maybe he knew what the data was going to be. Turns out, no. Maybe only Jay Powell gets the data ahead when he wants it, but doesn't look like Bostic had any kind of clue. And so the market and its run into the close yesterday wasn't really led by anything other than speculation. So, again, coming in hotter than expected here, also hits our trend numbers. We'll pull up the trend numbers here, which thank you, Nick T, for throwing those up. But Nick T gave us the trends, and this is the problem. The trend is not our friend when it comes to inflation. Here you go, on screen now, you've got Nick T. Everybody loves our Fed Whisperer. He gives us the 3, 6-month, and 12-month basis. And those here say what's going up are the courses on building your wealth from Meet Kevin, including all of the buy-sell alerts, trade alerts that we send in the Stocks and Psychology of Money group. We'll have a price increase within about the next 10 days on those. If you want to bundle up, make sure to email us at staff@meetkevin.com. You could bundle up with the event or other courses if you want, if you're an existing member or a new member or a curious member and you have questions. But anyway, so staff@meetkevin.com. But anyway, look at that core consumer price index right here. You see that 3, 6, and 12-month trend solidly moving up here. This is an issue because, again, at 5.5% rates, it means the Federal Reserve is not managing to control this inflation problem. So a little oopsie-doopsie. Again, we're not pricing in our full rate cut until November, and we are moving down on rate cut expectations to just one. Okay, we've just moved down even more. That's incredible. We are now down at 1.69. I'm gonna throw this screen on this chart on screen rather, but I want you to first see yesterday's data. So I got yesterday's data. I'll show that on screen first. Yesterday's data is right here. This is what it looks like in terms of the market pricing and cuts. The way to read this is these bars are basically number of rate cuts priced in. And if you hold your mouse right here for December, you'll be able to see we're pricing in negative 2.6 rate cuts as of yesterday. Negative 2.6, so basically 2.6 cuts for yesterday, okay? Today, we have now moved that number down again, because we were at 1.9. If I now hover over December, I get 1.692. That's it, 1.692 on rate cuts. That means we're getting to only pricing in about 1.5 rate cuts at this point. That might end up moving down on hawkish talk here to only pricing in 1 rate cut for the year. So big implications here, obviously, for the market broadly, for treasuries. We'll see how the market responds as the day's trading moves. I really think it's going to take probably the whole trading day to kind of figure this out. And then obviously we'll get PPI tomorrow as the next catalyst, and then we'll get Fed speak coming up. PPI for tomorrow, month over month, is expected to be 0.3. Core month over month is expected to be 0.2. Core less trade is expected to be 0.2. So we'll see. Usually those producer price numbers do come in lower. And then at the end of the week, we'll get sentiment, University of Michigan inflation expectations. Those are usually something that is closely watched or are closely watched by JPAL. So we'll look at those. Next week, we'll get retail sales, building permits, and some other smaller data sets as well. But obviously, 3 months now, much more than a bump in the road. This is turning into a trend. It's not great. Let's see how markets respond, though. Can we get a market rally here in spite of maybe not having rate cuts? Let's find out as we get ready for the trading.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than househack, nor am I presently acting as a market maker. Make sure if you're considering investing in househack to always read the PPM at househack.com.